So today is Monday, March 27th. This is the 2 p.m. section. This class is being recorded. So what we're going to focus our primary time today is finishing up the valuation model and setting you up to complete homework 9, which is due 1 week from today. So you'll need to basically make sure you get that file that we completed long ago before spring break up and open and ready to go. Okay, so I made a mistake. I thought I had made homework 8 due today. I accidentally made homework 8 due a week from today. So I'm not going to change that deadline. My mistake, I'll own it. But I will tell you that you should turn in the file that you completed essentially a week and a half ago in for homework 8. Most of you have probably already done that. You will need that file to complete homework 9, which is where we're going to start today. Originally, homework 9 was due in 2 weeks, but again, because I messed up the spring break, it's actually going to be due next week. So all the assignments have been moved up a week. Okay? In order to do homework 9, you're going to have to complete the file that we do in class today and the process that we go in class today to do homework 9. Okay? So just giving everybody a heads up. So while you're getting that file ready, I also want to let you know that today, the second half of the Bloomberg Trading Challenge is going to start. Okay? Sorry, what's going on with the screen? Okay. Same team, same captains. So I'm going to actually start you right now. So if I go to the Trading Challenge, you are section 301. So what I'm going to do is I'm going to clone this. Everybody starts with $1 million of fresh cash. All your historical trades have been wiped out. Same team captains. And I'm going to take myself out of this list. Somebody said they didn't want to see me on the list of companies in here. So let me do this. Okay, and we're going to call this 301. There it is. That's all right. Third time is going to be the charm. Networks. Closes empty network. Continue. This is 301, and it'll be called 2H. So when you go in here, you'll just have $1 million worth of cash. You have between now and next Monday to get out of cash. Starting next Monday, you can't have more than 300,000. You have to start doing a minimum of 10 trades longs this half of the semester. You're basically starting where you did at the beginning of the class, just rerunning another sim for 6 more weeks. Okay, same teams. Questions about the trading sim? So theoretically, you can start trading right now. Okay. Now, going back to today. So let's take the file that we worked on in class last week. Okay. So this is where we're going to start today. So what we did before spring break is we said, based on the historical data of Parker Hannafin, if the ratios for 2022 repeated themselves for the next 6 years in the future, these would be the financial statements, the income statements and balance sheets, which would create these economic statements, which specifically would create these CFIs and cash flows. Okay, so we have a forecast going forward. What we're going to do today is we're going to turn these forecasted cash flows into an enterprise discounted cash flow valuation. Okay, so that's where we're going to start. That's where we're going next. So to do that, we're going to take this model, we're going to add a new worksheet here at the end. And this new worksheet that we're going to add, I'm going to call this the DCF Valuation worksheet. Okay, so this is what you're copying, this is what you're doing in your own models. And as a reminder, I'm not giving you this file. So to do all the assignments going forward, you have to individually create this file. Without that, you won't be able to complete the assignments. Okay, so very important you do what we're about to do. All right, so starting out with the DCF valuation, we are going to follow Modigliani-Miller. Okay, Modigliani-Miller says a company's worth the sum of its future operating cash flows plus non-operating cash flows, and that will equal its enterprise value. The operating cash flows are based on the free cash flows. Well, we have actually forecasted the free cash flows. That is in our CFI. In our CFI, row 14, it should say free cash flow on it. Don't know why it got deleted there. But row 14 of our CFI is our forecasted free cash flows. And we have forecasted free cash flows for these 6 years. So as part of our valuation, we're going to take those forecasted cash flows, we're going to turn that into the DCF valuation. Now, following the ideas of the book, you always forecast 1 extra year in your valuation. So in our model, the first 5 years will be the 5 years of forecast, starting in 2028, which is year 6, the T plus 1 or the N plus 1 year. That's the start of the continuing value perpetuity period for the company, in this case, Parker Hannifin. Okay? So that's why we did 6 years. 5 years individual year by year, 6 years, year 6 into perpetuity. Okay, those are the 2 models that we're going to forecast. Right? So on this tab, we're going to start building out the valuation. So our first year of forecast, cell A2, equals, from the CFI, relative reference, H23, or sorry, H2, 2023. That's our first year. And I would say, gee, why did he put a reference there? Because again, if the years ever change, I want everything to flow through the model. Okay, don't want to hard code a first year here. And again, the first 5 years are the ones that are important, so I'm going to go down the rows, not across the columns. So equals previous year plus 1. So that, and then copy down. So I have 5 years of cell B1 free cash flow. So that's the first part of what we're forecasting. So I want free cash flow forecast for 23, 24, 25, 26, and 27. I am going to get that forecast off of the CFI. Right? So 2023 free cash flow, B2, equals, from the CFI, free cash flow is row 14, 2023 is column H, so H14. Okay. 2024 free cash flow equals, from the CFI, I14. 2025 free cash flow equals, from the CFI, J14. 26 from the CFI, K14, and 27 from the CFI, L14. So if our ratios come true, these would be the free cash flows for those 5 years. And from a formatting standpoint, just make it a little cleaner, we're putting everything in a 1 decimal place in the model, just to be consistent with the other tabs. These numbers are in millions. Okay? Now, these are the cash flows each of these 5 years, but if we're going to do a DCF, I have to present value them. So I got to present value all of those cash flows, which means I need to discount them. We are going to discount them at the assumptions, the WACC. So the WACC is our discount factor for the model. Okay, 8.4%, again, as a placeholder right now. So if I discount those cash flows at 8.4%, I go back to my DCF valuation, and I'm going to use the concept of a discount factor. So the whole point is present value equals cash flow divided by 1 plus R to the N or T power. Okay, that's the formula. So we have the cash flow times 1 divided by 1 plus R to the N or T power. That's the discount factor. So the discount factor equals 1 divided by, left paren, 1 plus the R. In this case, the R is the WACC. So in cell C2, 1 divided by 1 plus assumptions B4, right paren. So basically, it's the same as multiplying by 0.9225. Again, get a little cleaner. Put 4 decimal places here so it fits. But that would get me my discounted free cash flow, which is the free cash flow times the discount factor. So the present value of the 23 free cash flows, $1398.3. Okay. Now I'm going to do this for 5 years. So here's the point. When I copy cell C2 down, since I always want to refer to cell B4, I'm going to put a $sign in front of the B and a $sign in front of the 4. Make it an absolute reference. So I can copy cell C2 down to cell C6. But here's the point. When I get to year 2, it's 1 plus R to the power of T. So it's 1 plus assumptions B4 squared, power of 2. So at the end, shift 6 is to the power of the caret 2. Why'd that space get in there? Okay. Cell C4, at the end, shift 6, 3, power of 3. Shift 6, 4, and shift 6, 5 at the end. So 1 plus R squared, 1 plus R cubed, 1 plus R, etc. Okay, that's what I just did. So that, if I take column B times column C, I get the discounted free cash flows. Again, 1 decimal place, copy down. Okay, so those are the year-by-year free cash flows that we have forecasted off the CFI in present value. So if I were to add these 5 up, because they're now in present value, I can get the operating value for the first 5 years for Parker Hannifin. So cell D7 is the sum of those 5 discounted free cash flows, 74.8 million. Okay, so again, if our assumptions and our ratios come true, Parker Hannifin will generate about $7.3 billion worth of operating value in the next 5 years. Okay, but they don't just poof, go away after 5 years. They're going to continue operating. The difference between a project and a company is we assume companies last forever. So here's the point. They're not going to just end in 2028. So how are they going to do beyond? That's called the continuing value or the perpetuity period. So we need to value them long term, beyond year 5, year 6 into perpetuity. To do that, the key word there is perpetuity. We use a perpetuity, specifically a growing perpetuity. Okay? The book's version of the growing perpetuity, the key value driver equation. So going back to our lecture notes and our reading, from lecture 1, last slide, this is the key value driver equation. Okay? That's the equation on the right here is what we're going to use to value a company long term. That's the magic formula. So just to remind us, I'm going to take a screenshot of this. And I'm going to put this into our model. You don't have to do this. I'm just kind of doing it to illustrate what we're going to do here. A little bit smaller. But basically, this is the key value driver equation, and this is what we're going to use to value the company in continuing value. So starting in cell A9, continuing value period. In cell B9, we're going to basically put that formula into B9 to estimate year 6 in a perpetuities value. Okay? That formula has 3 things in it. It's got a profit, it's got a growth, it's got an ROIC, and it's got a WACC. Now these can change company by company. Okay? So I don't want to hard code these values in. Things that change company by company, I'm going to build this formula off the assumption screen. Okay? So back to the assumption screen, under WACC, we got one of the 4 pieces of the formula. We need 3 more. I need a continuing value NOPLAT, which is the profit. I need a continuing value ROIC, and I need a continuing value G. Those are the other 3 parts of the formula. And because those can change, yellow. I'm going to make all 3 of those yellow. The right color yellow. Having all sorts of mouse problems today. Sorry about that. There we go. All right, so we already have the WACC, which we'll update in a little while. It's a placeholder. I need a continuing value NOPLAT. So here's what we're going to use as a starting point. For cell B5 and the assumptions equals, from the TII, we have a forecast for NOPLAT in the continuing value period. That's our 2028 NOPLAT as a starting point. So M5 off of TII is our continuing value NOPLAT. So that was the whole point. That's why we forecasted that year 6. That N+1 year is the starting NOPLAT for a perpetuity. Okay? Now, very important, right now we're just arbitrarily using this year 6 one, and we're saying that's representative. If, for example, we think that at the end of year 6 we're in a terrible recession, and this is in a bottom part of a cycle for Parker Hannifin, we may not want to use that year 6, and we might want to put in something that's more representative. Okay? But as we're building the model, we're going to at least start with the year 6 NOPLAT as representative of perpetuity, the starting point. Okay? Next, same thing, we need our year 6 ROIC. So B6 equals, from the EP tab, again, we're forecasting an ROIC, it's row 16. In 2028, that is M16. That is the 2028 ROIC, again, 1 decimal place, 14.6%, again, assuming our ratios come true. The final number we need is our continuing value growth rate into perpetuity, yes? Economic profit, the economic profit tab. We then need a G, continuing value growth. This is the very long-term growth rate. Think like a 30-year growth rate for a company, okay? As a placeholder, we're going to start with 3%. You might say, gee, why is he starting with 3%? Because typically, we assume mature companies tend to grow with economies, and the US-based companies generally grow about 2 to 3% a year long-term. So we're going to start at 3% as a placeholder, but later today, we'll talk about how to adjust that for Parker Hannifin. Okay? So those are our 4 starting numbers for the continuing value of Parker Hannifin. Okay? So here's what we're going to do. We're now going to go back to our valuation tab, and using that formula and those 4 numbers off the assumptions, we're going to estimate the continuing value. So for cell B9 equals left paren from the assumptions tab, profit, which is B5, times left paren 1 minus the growth, which is B7, divided by the ROIC, which is B6, right paren, divided by left paren, the WACC, which is B4, minus the G, which is B7, right paren. $62,343,000,000. Okay? So again, if those continuing value numbers come true, $62 billion of value after year 6 for Parker Hannifin. And I'm going to double click on this because I do this formula all the time. So I'm pretty proficient at putting this in, but you may not be. If you're watching this in the video, you're welcome to pause this. But that's the formula with the correct order of operations. This will be the hardest thing you got to do. Okay? All right. Here's the challenge, though. We're doing an NPV, that's what the DCF is, and this is the value at the beginning of year 6. I need to put that into today's value. So I have to bring this value back to today. So I have to discount it back to today. To do so, I'm going to use the same discount factor as year 5. Because January 1st, year 6 is pretty much the same as December 31st, year 5. Okay? And the perpetuity formula, the continuing value formula, already discounts the cash flows to the beginning of the period. So year 6 has already been discounted in this formula. But I have to discount them 5 more years to bring it back to today. So equals same discount factor we used for year 5. Don't double discount. That's a common error people make. Equals free cash flow times discount factor, 41.6 billion. So the total operating value, row 11, of Parker Hannifin is the 7.274 billion of cash flow in the first 5 years, plus the 41.6 billion in perpetuity, and their total operating value, 48.9 billion and change. That is our forecast for the operating value of Parker Hannifin. Questions? Back to Modigliani Miller. Operating value plus non-operating value equals enterprise value. Okay? We have the operating value. Now we have to forecast the non-operating value. Okay? So for non-operating value, here is where the converted statements help us. You would have appreciated this in the work you did on the midterm. So back in TFI, we converted the balance sheet into operating and non-operating assets. These are the non-operating items on our standardized balance sheet. Okay? Excess cash, non-operating assets, less non-operating liabilities, and long-term investments. Okay? So what I need is the value of those 3 items. This is the non-operating value. A couple of assumptions. Assumption number 1, companies are not good at non-operating things. I don't invest in Parker Hannifin for their non-operating business. I invest in Parker Hannifin for their operating business. So the assumption we often make is in the future, non-operating investments are NPV 0. Okay? You're not going to add or subtract value because you're not good at it. So we'll give you credit for it, but we're not going to invest in you and you're going to create a lot of value for the non-operating assets. Are there exceptions to this? Yes. If you're dealing with an exception, you're always welcome to change the value to what you think they are. But for simplicity, our starting point is the current value of the non-operating assets. Because assumption number 2 is that the accountants are doing their jobs. Because here's the point. If the accountants are doing their jobs, then the numbers that I see on the balance sheet should be a floor. Okay? May not be a ceiling, but it should be a floor. Because those non-operating assets have lost value, they should have forced the company to write it down. So the non-operating values in the balance sheet are at least a value that should be quasi-realistic. As I said, if it's far different than the true balance sheet values, we can always overwrite these fields. But for the vast majority of companies, you won't be doing that. And as you're about to see for Parker Hannifin, their non-operating assets are pretty trivial. Okay? So let's put their non-operating assets into our valuation. So starting in row 13, what are the 3 non-operating assets off the TFI? So A13 equals TFI, A10, excess cash, A11, non-operating assets minus the non-operating liabilities, and A12, which is long-term investments. Those are the 3 non-operating assets on our standardized balance sheet. Okay? What are the current values of these? Not the 2028 values, but the last reported values in 2022. What are they worth today? Well, how much cash they have on today equals from TFI, 2022, last reported year, 246.4 million, so G10. Non-operating assets, G11. Long-term investments, G12. Again, one decimal place. But if I add these three things up, this would be the non-operating value of Parker Hannifin. Just add these three up. So it's about 283 million. Okay? So back to Modigliani Miller. I got 48.9 billion of operating value. I got 283 million of non-operating value. I add the two together, that's my enterprise value. Okay? So I go to row 19 and I start typing in enterprise value equals D11 plus D17. 49,210.4. Okay, again, one decimal place. All right, following what you did on the midterm, operating plus non-operating value has to equal the debt and the equity value. All right, we're trying to get to a share price. So here's the point. From that enterprise value, we got to pay off all the debt. They come first. So we subtract off all the debt holders. Then we subtract off the non-common shareholders. They get paid first. Preferred shareholders, minority shareholders. Whatever's left, that residual, belongs to the common shareholders. So that's the point. We got to pay them first. Again, this is where TFI helps us because we've identified the stakeholders. So the first stakeholder that we have to pay equals, from our TFI, we have to pay the retirement-related liabilities. We have to pay, from the TFI, the interest-bearing debt. We have to pay off, we're solving for common, so we have to pay off the preferred. And we have to pay off from the TFI the minority shareholders. So those are the four stakeholders that have to be paid off. And again, what do I owe them now? Those are the 2022 results. So in 2022, for retirement-related liabilities equals, from the TFI, column G is the last reported year of actual, G15 is retirement, G16 is interest-bearing debt equals, from TFI, G18 is preferred stock. Now again, it's 0 for Parker, but it might not be for another company. And G19 off of TFI is what I owe to the minority shareholders. So this is what is owed to the non-common shareholders of Parker Hannifin. So if I take my enterprise value and I pay all of them off what I owe them today, I am left with a common equity value of the company. So equals enterprise value minus the sum of those four items. $39,942,000,000. So I want to translate this into share price. So if I then know the shares outstanding, I can get a model share price. Okay. So here, yes? Sure. I'm just taking the enterprise value minus those four things. So I did the sum of the four. You could just do D19 minus, whatever that is, 21 minus D22 minus D23 minus D24. Subtracting those four. Okay? Yes?
Why did you add cash back?
We did. We added the cash as a non-operating asset. It's the excess cash right there.
Oh, okay. Never mind.
That's part of the enterprise value on the other side.
Cool, get it.
Yes. So we don't do a net debt in this class. Okay. Some people will do a net debt when they do the value. We actually break it out. We put the cash as a non-operating asset. We put the debt as a debt equivalent. So we're doing a true Modigliani-Miller here. Okay. All right. So back to this. We got 36.9 billion of value. We need to know how many shares outstanding they have. Here's where our model ties back to Bloomberg. You will need 3 screenshots for every valuation from Bloomberg. Without the screenshots, you get zeros on your homework assignments. So no credit without the screenshots. Right? The screenshots help us complete the valuations. First screenshot. So we're going to go to Bloomberg. We're going to look up Parker Hannifin. And the first screenshot is DES, security description. So you're going to go to the screen, and then you're going to take a screenshot, save. Now the format I typically use is ticker PH-DES. Bloomberg screenshot name. Okay? But basically, you're going to need a DES screenshot for every company, okay? Including this one. Why? 2 data points off of this screenshot. If I value the Parker Hannifin company at 11 a.m. versus 2 p.m., that share price is jumping around all day long. And if I do it today versus Wednesday, it's going to jump around even more. So that's the point. We need to know when you turn in your models what share price you were using because it's changing. So the DES is the official share price of record that your model is based on. That's the first reason why we're using the DES. Just arbitrarily, I've chosen that screen. But the other reason is right here, shares outstanding. On the DES screen is your quick guide to the current shares outstanding of a company, right? For Parker Hannifin, it's 128.3 million, right there. So I need to put 128.3 into this field. But here's the problem. I don't want to put it here because it's going to change if I do Nike, okay, or if I do anybody else. So where I'm going to put the share price, shares outstanding, to calculate the share price, is on the assumption screen, A8. Shares outstanding. Next assumption down. Make that yellow. And again, from my screenshot, 128.3. And while I'm here, current share price. From my screenshots, this one will be on the video, 324.55. So I need those 2 numbers from the DES screen. Current share price and the share count. So now that I have the shares here, I go back to my DCF for shares outstanding equals, from the assumptions, shares outstanding, B8, so that my model share price is the equity value divided by the shares outstanding. If all my assumptions come true, 287.94. Structurally, when you get to this point, you have structurally completed most of the DCF valuation. Not that hard, just a bunch of algebra. By the way, I'm handing around the sign-in sheet. Please make sure you sign the sign-in sheet before you complete that. So, questions about what we have done so far? Yes, sir.
Can I see a formula for the operating value again?
The operating value is the first 5 years plus the continuing value DCF. So D7 plus D9. Okay. Any other questions? All right, we're not done. So here's the point. When you do a company's valuation in this class, you will do 4 Excel files. All right, the first one is actually something that's not really done anywhere else. It's kind of unique to this class, but I found that people that have been through this class use this in the real world because they find it helpful, and that is a process known as the as-is valuation. Okay, because what a lot of people do is they just say, okay, now that I got my model, let me start putting in my own assumptions and crank out what I think Parker Hannifin is worth. That's called a target valuation. Everybody does that. That's what we're working towards. But before we go there, we're going to stick in an intermediate step, and we're going to say, what's Parker Hannifin trading at right now? 324.55. Let's build a model that exactly equals 324.55, so we have good starting assumptions that lead to that price. That's called the as-is. Okay? So the whole point of the as-is is I want to model the current share price. I don't want to model what I think it should be. I want to model what it is. And I want to back into, using these formulas, reasonable assumptions that the market had to use in order to get to this share price. Then I can decide whether or not I agree with that price, create my own. Okay, that's called the target. Okay? By the way, what we're also going to do next week is you're not just going to give me a target. Models number 3 and 4 are called the bull and the bear. You give me a range. So what do I think Parker Hannifin is worth? And oh, by the way, in the next 12 months, how high do I think it could go if everything goes right? And how low do I think it could go if everything goes wrong? So I'm going to give you a range, and I'm going to tell you where on that range I think the company should trade. Bull, bear, target. That's models 2, 3, and 4. Okay? Today, our first step is the as-is. Model the share price today. So we need our model to be 324.55. And right now, it's 287.94. Okay? So I am lazy and I don't like to keep jumping back and forth every time I change a number to see what happens. So what I'm going to do is I'm going to reference this cell, the model share price, on the assumptions tab. So right here next to current share price equals, from the DCF valuation, the model share price. Actually, I'll put this into here, and I'll put the words here. Okay? So that's the point. I want these two numbers to equal each other. Now, the standard that I'm going to give you is within $1. I'll consider that exact. Okay? But before we leave today, we are going to be exact. And I'm going to show you how to be exactly exact. Okay? But we want these two to equal each other. All right? So that's the next step in our process. How do we get our model to be 324.55? Okay? Screenshot number 2. We need a current WACC. Okay? We put this WACC in as a placeholder. I need to know what their current WACC is today. So back to Bloomberg. WACC is the current WACC. That's what we're going to use. Screenshot number 2. Take screenshot, save screenshot, Parker Hannifin dash WACC. Okay, 8.3% is the number right now. So I'm going to go back to my spreadsheet. It was close to our starting assumption, 8.3. But notice when I made it 8.3, that share price is now $295. So lower WACC, slightly higher cash flow value. Everyone with me? Okay. So now that we've gotten the WACC, we have to go the key part of our forecast, and you can see it on the DCF. This operating value is primarily driven, or this enterprise value is primarily driven by the operating value, not the non-operating value. That's what matters. We got to get the operating value right. Okay? Which means I got to get these first 5 years right if I'm going to value them today. Well, here's the thing. The analysts that work on Wall Street are doing the exact same thing. Okay? The sell-side analysts who know Parker Hannifin much better than we do are actually forecasting Parker Hannifin and they're uploading their forecast to Bloomberg. And Bloomberg is aggregating all those models in a screen called EEO. That's the consensus estimate. And there is a forecast, which is the wisdom of the crowd, of the sell-siders. There's the forecast for revenue and other numbers for Parker Hannifin going into the future. I don't think, for the purposes of the as-is, this is the baseline Wall Street's using, that we're going to do better than their baseline, so we're going to use their baseline for the as-is. Okay? Now, what do we need off of the EEO? Back to our valuation. We need free cash flow. So back to the ratios. What drives free cash flow off of our ratios? Those three rows that are highlighted in light gray are the most important forecast items for free cash flow. Revenue, EBITDA, tax rate. That's no plat. Those are the drivers of no plat. Okay? So I'm telling you, 80-20 rule, okay, that the most important things you can forecast in your model are those three numbers. Not saying that other things won't matter, but these are the most important. That's gross cash flow. Okay? Now, the other thing we need is gross investment. Here is where our ratios of the balance sheet help us. All of the ratios down here of the balance sheet are a percentage of sales. The advantage of doing it this way is that when sales grow and the balance sheet's a percentage of sales, the balance sheet will grow with it automatically in the model. So the model will default forecast a balance sheet for you if you forecast an income statement. So you don't have to change the forecast for the balance sheet most of the time. And gross investment is the delta between those two balance sheets. So basically the model will auto-calculate your gross investment. So as I said, most of your valuation time is get the growth rate right for revenue, get the EBITDA margin right, get the tax rate right. The balance sheet will auto-forecast the gross investment. You'll get most of your free cash flow right there. Now here's the exception. That's why I put this row 24 down there of invested capital to sales. Right now, the productivity of Parker Hannifin is $1.33 to 1. All right? When I forecast them in the future, I don't want this going back down to 70 cents. All right? Companies tend to maintain their invested capitals to sales over time unless they do acquisitions. Okay? And if we're not forecasting acquisitions, their productivity should probably stay the same. So therefore, I should have similar productivities in the future. If I don't, I can adjust the balance sheet ratios. Or if I know the company's going to do something different, I can adjust the balance sheet ratios. In the case of Parker Hannifin, they were buying a company, it was called Megit. Their working capital spiked in 2022 because they had actually raised a bunch of cash to complete the acquisition, but they hadn't actually paid it out. So their working capital was artificially higher in 2022 than it was in previous years. No team mentioned that, and I didn't penalize you because you didn't understand this. And I was actually found this out because I was sitting next to the Parker Hannifin when I went to Singapore at dinner. I was like, why'd your working capital go? He was like, oh, this is something that even the analysts didn't pick up on, but we had actually had a bunch of cash for the acquisition that hadn't closed that was sitting in our checking account. So that's the point. Like, if I knew that, then the ratio for working capital to sales should probably be lower in the future, and they would actually have a better balance sheet. So I could change this if I had the information. But if I don't have the information, I'll at least leave today play out. Okay? So back to this. These are the three most important numbers to forecast. Let's start with the tax rate. I need to know a realistic tax rate for Parker Hannifin going forward. So do the analysts. Two sources for the tax rate. The first source, back to Bloomberg, guidance. GUID. This is the guidance that the company is giving to Wall Street. We can scroll through and see whether or not the company is giving tax rate guidance. It is. Going forward, 23.5%. So Parker Hannifin is telling the market, we think our tax rate is going to be about 23.5%. So I'm telling you, whether you work at Goldman, JP Morgan, or Deutsche Bank, it's probably the number you're going to use in your spreadsheet, or at least close to that number for their tax rate, right? So that's the point. This is the number that they say that they are probably going to pay. So back to our model. Starting in cell H10, off the ratios, 23.5%. If the company does not give guidance for the tax rate, the analysts have to figure it out themselves. So what I would then suggest is go to BRC, open up an analyst report. JP Morgan is something that we have access to. Every JP Morgan analyst report puts in a financial forecast. Every financial forecast of JP Morgan has a forecasted tax rate. So in this class, if a company doesn't give guidance, go open up an analyst report from JP Morgan, see what they're using for the forecasted tax rate, copy them. Okay? Because like I said, JP Morgan, great firm, they probably have a good sense of what a company's going to pay going forward. So they're probably not going to be too far off. That's your backup plan. Okay? All right. Next, we need to get the EBITDA margin right, and we need to get the revenue growth rate right. Again, here's where we go to screenshot number 3. Screenshot number 3, EEO. This is the third screenshot you're going to need for every company. Take screenshot, save, PH-EEO. Why do we need this screenshot? The analysts are doing exactly what we're doing. They're forecasting revenue. There's the next 4 years. They're forecasting EBITDA. There's the next 4 years. Take EBITDA divided by revenue. They're forecasting the EBITDA margin. So sitting here in the EEO is the forecast for the EBITDA margin for Parker Hannifin. If I switch over here to headline growth tab, those are the revenue growth rates for Parker Hannifin for the next 4 years. When we're doing the as is, I don't think we're going to do better than the market consensus. So we're going to use the consensus growth rate and the consensus EBITDA margin for our as is valuation. Okay? So basically, in our model, because we're going to replicate this for other companies, including Homework 9, back to assumptions. Our first year equals 2022 plus 1. That's the first forward year. Again, I'm not hard coding the year because the years ever change. I want the model to auto adjust. And equals previous year plus 1 for the next 5 years. So we have to forecast year by year for the next 5 years. Let's use what the analysts have said for the next 5 years for the company that we're valuing. Okay? Then we'll worry about the continuing value period. Okay? So what do we need to know from the analysts? We need to know the revenue growth rate. We need to know the revenue in dollars. We need to know the forecast for the EBITDA in dollars because that will get us our EBITDA margin as a percentage. And starting at B12 through F14, these are yellow. So they're going to change company by company. Okay. So now you can export the data, or in this case, I could just type in. So revenue growth rate for 2023, 16.22%. So right here, 16.22%. All right. For 2024, revenue growth rate, 5.52% is the current consensus. For 2025, it's 4.96%. For 2026, it's 5.05%. And if I go back to Bloomberg, go down here at the bottom, hit right arrow. For 2027, year 5, 4.24%. Okay, so the columns just don't end after 4 years. You can actually scroll right somewhere. So 4.24%. Those are the growth rates for the next 5 years. Okay? That will lead to the next row down, which is the actual dollars of revenue, okay, for the next 5 years. So back to Bloomberg, column number 1, or so tab number 1, headline, go back to this one, revenue, 2000, got to go back a column here, 2023, 18,435. In 2024, it grows to 19,452. 2024. 2025, it grows to 20,416. 2026, revenue would then grow to 21,448. And again, scroll down, move over an extra column. 2027 revenue is expected to grow to 22,357. Okay. Same thing for EBITDA. Okay. So EBITDA in 2023, go back a column. 2023 EBITDA consensus is 4132. $2024 is 4445. 2025 EBITDA is 4858. $2026 is 5092. And 2027 is 5364. So that the EBITDA margin equals the 2023 EBITDA divided by the 2023 revenue forecast, 22.4%. Sorry, 22.4, and that is expected to grow by 2027 to 24%. So that's what the analysts are forecasting right now in the consensus, average of all the guesses. Questions about any of that? So we'll start with the EBITDA margin. These are the forecasted EBITDA margins of the consensus. These in the ratios are the EBITDA margin our model is forecasting. Replace. 2023 EBITDA margin equals, from the assumptions tab, 2023 consensus. B15. And then just copy it over the 5 years. I'm also going to take these 5 years worth of data and I'm going to not make them yellow anymore, because I'm not directly putting them into the ratios, I'm getting them from the assumptions. By the way, when we put in these more realistic EBITDA margins and the more realistic tax rate, notice our share price in the model is 326 and the real world is 325. We're not done, that's just coincidence, but we're a lot closer. Okay? Now, here's the thing. The most important changes are happening here and happening here. And I don't want to keep jumping around, okay? So the other thing I'm going to do, so I can just look at when I change a number to see what happens, is down here in row 26, what I'm going to do is here, equals, assumptions, current share price, equals, assumptions, model share price so that I can see what the two of these are, and I don't have to keep jumping around to different tabs every time I change something. So every time I change something as a ratio, I can look at the bottom of the screen and see it change in real time. Because our goal is to get those to match. Within $1, but to match. Okay? Now, we put in the EBITDA margin, but we haven't put in the revenue growth rates. So remember, right now, the revenue growth rate is just a placeholder. Right? So now we want to put in the consensus revenue growth rates for the 5 years. So starting in, question?
What do we do with 2028 for the EBITDA?
We,
Is that just left as the previous?
yes. And we'll come back to that one. But let me finish this, and then we'll come back to this. So for revenue growth rate in 23, the consensus equals, from the assumptions, B12, and then dot, 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 C12, E12, etc. So copy and paste this over the 5 years. And then take out the yellow. So what I've done is I've put in the next 5 years of consensus growth rates and the next 5 years of consensus EBITDA margin and basically the tax rate guidance the company's had. And now that share price is $258. Because obviously it was closer because the revenue growth rate was 16% a year and they're not going to grow 16% a year. So share price is now lower. So I need to now get 258 closer to 324. Right? Before I do, her question was, what about the continuing value period? For purposes of today, we're going to assume that these are realistic into perpetuity. Okay? But this is an important question because if 4.2% is not a realistic growth rate for that 6th year, we should adjust it. And right now I'm assuming that year 5 and year 6 look pretty similar. Okay? Same thing. If that EBITDA margin into perpetuity is not 24%, it's closer to 21 or 22%, I would need to adjust the year 6 because that's the perpetuity year. Okay? But for now, let's assume year 5 and year 6 look about the same. So we're going to leave those for today the same. Okay? And I'm highlighting what we're going to do next Monday. Okay? So, everybody with me so far? So here's the last important variable. So far, we have forecasted the, on the previous page, the WACC, current WACC, right? We have the tax rate for the guidance. We have the EBITDA margin and the growth rate year by year for the 5 years. The last and probably most important thing we need is the G, the long-term 30-year growth rate for a company, the very long-term growth rate, the one that we just said leaves 3%. Okay? And again, if you go back to your valuation, you can see how important it is because the real value of Parker Hannifin is not in the first 5 years. It's in this perpetuity period. And the key driver of the perpetuity is how fast you're growing that ROIC. So that G is really critical to your valuation model, and we're going to spend more time on getting the G right next week. But unfortunately, the G is a blunt force instrument because it's one number for the entire future growth rate of the firm. And small changes in that number can have huge impacts on valuation. So this is actually one of the most important things to get right in a valuation. Okay? So here's how we're going to start. I know that right now as a placeholder, I put in 3% and I got a 258 share price. So the G's got to be higher than 3% if the market's pricing them at 324. So my first question is, what G must the market be using? So we're going to keep changing this G until these two share prices are the same. So I'm going to show you how to do it the easy way. Okay? And the easy way is to, in Excel, go to Tools, Goal Seek. Okay? We're going to let Excel do the what ifs. Okay? And so here's how Goal Seek will work. We're going to set cell, the model share price, off the valuation is D30. Okay? And we want D30 to be 324.55, the current share price. And we want Excel to make these two equal by changing B7, which is the G. So that when I hit OK, Excel is going to iterate through until those two share prices are identical. And that G is 4.6%. Yes?
For some reason, there's no tools on this Excel. Is there another way to do it?
So if you have the other version of Excel, it should be under, I believe it's data, and is it what if? Data, what if off the ribbon, which I hate this stupid ribbon, goal seek. So it's goal seek in the Windows version. So it's off the ribbon, what if, goal seek. Same idea, yes. Sure. So in goal seek, sorry, data, tools, goal seek, there it is. What you want to do is you want to set the cell, whatever you're trying to solve for, which in this case is the share price, so DCF model share price, okay, to whatever value you want it to become. It's got to be set to a formula. You can't do this for a hard-coded number. So I want it to be the current share price, which is $324.55. And so what I'm saying is get Excel to basically put in a bunch of guesses by changing the G, which is B7, until that share price of the valuation is $324.55. So when you hit OK, it's going to do it almost instantaneously. But basically, it will keep putting in numbers until it solves that equation. And 4.6 is the G that gets the share prices to match. Now, back in the day, when I was young and like you, we had Lotus 123 and much slower computers. So it would take like 30 seconds to do the goal seek. So you could go get a cup of coffee waiting out to try to actually go through all the iterations. Now computers are so fast that it's like instantaneous. But regardless, that's what we want to do. This is called the as is. So here's what I know. If I saw a JP Morgan analyst report or Goldman Sachs analyst report or Deutsche Bank analyst report, their spreadsheet looks a lot like this if they're trying to model the current share price of Parker Hannifin, because it has to be. These cash flows at this discount rate equal that share price. That's the whole point of the as is. Okay? It's not whether I agree with the price. That's next week. It's called the target. We're just valuing the company as it is today. All right, questions about what we did, how we got here? Are you able to get here? Yes.
Do we need just the one screenshot from the EEO screen because we use two different tabs on that?
I am saying that you only need one EEO because if you put in those growth rates, you get to that revenue. So I don't really need, if you want to do it in a redundant one, you can, but I'm saying because you're also putting in the revenue, those growth rates equal that revenue. So I know that you had to put in those growth rates, otherwise your model will be off, right? But again, 3 screenshots, DES, WAC, EEO, right? The reason why this is important, beyond I want to make sure you're doing the right things, is because you're going to be doing the valuation of homework 9 at a different time. And depending on when you do it, those values in those screenshots will be different. And the only way the TAs can validate that you actually did it right is they got to see what numbers you were using. So that's why the screenshots are very important to the valuation. Okay? Now, your homework 9 is not to turn in this file. Your homework 9 is to do an as-is valuation of Starbucks using this file. Okay? So same process that we just went through for Parker Hannifin, you have to do for Starbucks, using this exact same model and update it with a new company's data. Okay? There's no write-up, but you got to get there by next Monday. Now this has been recorded, and I'm going to remind you of how we get the data from Starbucks and put it in and update this model in just a second. But that is your next graded homework assignment. Due 1 week from today. Yes?
And it's the same 3 screenshots for Starbucks.
It's the same what?
3 screenshots.
Same 3 screenshots. It's just going to be the Starbucks DES, the Starbucks EEO, and the Starbucks WAC. And the Starbucks model with the Starbucks data. Not Parker anymore. Yes?
So should we duplicate this file?
Yes, you should. Because you won't be able to do Starbucks if you didn't get to this point. This is a big assignment, It's 4 points of your semester grade. It's the biggest homework assignment of the semester. It's due next Monday. As I said, if you didn't build the first half before spring break, you can't get to where we are today. If you don't get to where we are today, you can't do Starbucks or any other assignment, and therefore you're going to struggle because I am not posting any solutions. You have to create these files yourselves. That's the only way you're going to learn how to do this. You can't have somebody else do it for you. Okay? So, back to what do you need to do to turn this, which I would save, Parker, and I would now call this my, instead of start, this is my as is. That's the lingo for this version of the file. Next Monday in class, we will talk about how we do a bull, a bear, and a target off of this model for Parker. Okay? But what your homework assignment 9 is an as is of Starbucks. Just to get to this point, there's no write-up, but 3 screenshots in an Excel file that matches. All right? So how do I turn this model into a Starbucks model? Reminder, go back to Bloomberg. Go to SBUX. FA is historical data, custom. You will need to create a custom data export. What you're creating is 6 years of data. Bloomberg defaults to 10. The model wants 6. So, settings, number of periods, 10 to 6. Change that to 6. Second tab, data. All 4 of these boxes, uncheck. Because we only want 6 columns, we don't want anything else. And Bloomberg will give you other stuff, and those extra columns won't break, they'll break the model. So you can only do 6. So none of those 4 should be checked, and 6 years, not 10. Okay? Update this. On your terminal, it will always update. It'll always have this model. Then, if you haven't done this, and I told you this before, model data is what you got to export. Column B is the critical column. Those are the database field names in the order that they exist that you have to create as your model. So, starting with revenue, easiest way to do this, take cell B6, copy it, go to Bloomberg, where it says enter field, paste it, select the top one, hover over it, make sure that pop-up box says sales rev turn, move on to the next one. Repeat that process 79 more times. You need those fields for 6 years in this exact order. Okay? That's what will work with this model. Okay? So again, cost of revenue, copy, enter field, paste, cost of revenue, move on to the next one. For 2 of the fields, I don't know why, Bloomberg is not perfect. You will put in the database field and it won't find it. Right? I don't know why. It's there. So what you have to do is if you put in column B and it can't find it, go to column A, put in the friendly name, and it will find it. Okay? Just a little quirk we've run into in creating this. Okay? So if you can't find the database field, which it should, it's there, sometimes you can't find it in its own database, go to column A, search for it, and then make sure you do the same one that's in column B. You'll have to do that for 2 of the fields. Just warning you in advance. Once you've created this template, save the template. Okay? Name it something. Mine is called model. Then, for Starbucks, with your saved template, export to Excel the current template. Export to Excel the current template. And that will take all of this data for Starbucks and put it into Excel. It's right there, popping up. Now, very important. If it does not export to Excel, and you see something on here that says pound name, your export's not working. It's happening for one of two reasons. Number one, there has to be a plugin installed on each of these terminals that links Excel to Bloomberg. If that Excel has not been installed, the plugin to Bloomberg, it won't export the data. Bloomberg just won't put their data anywhere. So if that occurs, you can't install the plugin, you have to go to another terminal. Problem number two, there is a data export limit on every terminal here. When you hit the data export limit, that terminal will not export any more data until the first of the next month. Unfortunately, the PhD students use this lab like locusts. And what they do is for their projects, they suck up as much data as they can on a terminal until they bleed it dry, and then they go to the next terminal, and then they bleed that one dry. And they just start on one side of the room and work their way through. We can't prevent them from using these rooms. So I'm also telling you, if you run into a terminal and won't export the data, go to another terminal, okay? And for the last 2 weeks of the month, there's not much we can do. Freeze up better in April, okay? But regardless, you have to do this. Once you've exported the data, two other important things. You see these dashes. We gotta get rid of those. And you see these numbers. These are not numbers. So, select the whole worksheet, copy the whole worksheet, select the whole worksheet, paste special values, turn them into numbers. Otherwise, when you put them into that spreadsheet, it's gonna error out. And Excel chokes on these dashes. Copy a dash, find a dash, paste the long dash in. Replace all these long dashes with zeros. Replace all. You'll have to replace 42 dashes with zeros. It's the quickest way to do it. But once you've done this, File, Save As. This is my Starbucks data file. Okay? Now, last part, put it here, I can find it. Once you have this file, you select the whole file that you've exported, you copy it, you go back to the Parker-Hannifin model that you created, the first tab, you select the whole tab, right-click, paste special values, and now, let me try it again. Copy, select, paste special. I don't know why it's not. Anyways, paste special values. My Mac and Windows version of Excel are not cooperating right now. But basically, paste special values, and it will update cell for cell. Now you have the Parker-Hannifin data. It's been replaced by Starbucks. Make sure you have through 2022, so you don't have to change the year, but you got to put in their WACC, you got to put in their share count, you got to put in their share price, you got to put in their EEO growth rates, you got to put in their EEO revenue, you got to put their EEO EBITDA and EBITDA margins, you got to put in their tax rate. And you basically have to solve for their growth that equals the matching share price. This is due 1 week from today. There is no lecture on Wednesday. I am giving you Wednesday as a lab day to work on the assignment. And you're going to need that time to come in here and do it. Get all your data. Last but not least, the TAs have all done this before. And they will have the solution files. So if you're really struggling, take advantage of their office hours this week. Our next live lecture, 1 week from today. See everybody on Monday. Where's the sign-in sheet? Make sure you sign the sign-in sheet before you leave. And again, this was recorded and will be posted online. So let me stop the recording.